Almost every nation on Earth runs up debt, even the richest ones. In fact, by the mid-2020s, global public debt has soared past $100 trillion. For perspective, the United States alone owes about $36.2 trillion, roughly 122% of its annual GDP. Japan's debt is even more staggering, about 2.5 times its GDP. Yet debt by itself isn't a bug. It's a feature of how modern economies run. This video will untangle why debt has become the norm, who is lending money to governments, and when debt helps or hurts a country. Debt often gets talked about as if it were a catastrophe waiting to happen. But in many ways, sovereign debt is just the invisible engine of government finance, much like businesses borrow for expansion or families take out mortgages. Across the globe, governments borrow to pay for infrastructure, education, and emergencies. We'll reveal the surprising truth. Debt is a global reality, not an anomaly. We'll show how public borrowing is measured, debt to GDP, who actually holds these IOUs, and why debt can be both a useful tool and a dangerous trap. With clear analogies and data-driven analysis, each section will unpack the story of national debt, from historical cases of defaults to modern policy debates. By the end, you'll see that worrying about national debt is not about the raw number, but about how it's managed. Whether you live in a superpower or a small island nation, understanding debt is crucial. It underpins budgets, affects currency value, and even touches your daily life through taxes and social programs. So let's dive in and demystify why every country is in debt and who they actually owe. Imagine the global economy as a community where every household is carrying some loans. That's essentially the situation with nations today. Every country, from the poorest to the wealthiest, owes money. According to the IMF, global government debt is expected to exceed $100 trillion in 2024 and could keep rising. In other words, the sum of all national debts is about equal to all the economic output of the world today. This universal borrowing is partly because running a modern state requires constant spending on things like infrastructure, education, or healthcare, which often exceed tax revenues. Yet it might surprise you to learn that high debt levels are common even in rich nations. The United States, for instance, has the largest national debt of any country, over $36 trillion. Japan's debt is enormous too, roughly 250% of its GDP, higher than any other major economy. And many European countries like Greece or Italy carry debts around or above 100% of GDP. By contrast, only a few places have very low debt. Oil-rich states like Kuwait or emerging market economies might keep debt to GDP well below 40%. On average, advanced economies today have debt well over 80% of GDP. Why are debt levels so high worldwide? Partly it's a legacy of history. The global financial crisis of 2008, followed by pandemic relief spending, pushed many governments to borrow heavily. For example, U.S. federal deficits hit $3.1 trillion in 2020, more than double the previous record, as revenues collapsed and spending soared during COVID-19. When crisis hits, running deficits is often the quickest way for governments to stabilize economies. It's important to stress, having debt is not inherently bad. In fact, borrowing is an accepted way to finance growth. The key question is how debt is used and managed. Japan's case illustrates this. Despite having debt equal to 2.5 times its GDP, it never experienced a default or fiscal crisis. Why? Because much of Japan's debt is held domestically, interest rates are very low, and it has a strong economy. In contrast, other countries have gotten into trouble when debt skyrockets alongside fiscal mismanagement or external pressures. We'll explore examples of both scenarios. In this section, we've set the stage. Debt is everywhere, and even top economies borrow. Next, we'll break down exactly what national debt is, how it's measured, and why governments turn to the bond markets instead of just raising taxes. These fundamentals will help you understand the deeper story as we unpack the roles of lenders, borrowers, and the markets. When people talk about a country's debt, they mean the total amount the government owes to its creditors. Unlike a household loan, National debt isn't a credit card balance that someone forgot to pay. It's the sum of all past deficits, years when spending exceeded revenue, rolled into bonds and other securities. Think of government bonds as I owe us. Each bond is a promise. Lend me money now, and I'll pay you back later with interest. Governments issue trillions of dollars worth of these bonds to cover budget gaps and fund programs. This concept is actually similar to personal finance in one way. Like a homeowner taking a mortgage for a house or students borrowing for college, governments issue debt to spend on big-ticket items. But there are critical differences too. A key one is sovereign currency control. Most countries borrow in their own currency, like dollars, euros, yen. That means, in theory, they can always create more of that currency to pay off obligations. For example, the US government can issue new dollars to cover maturing bills. Of course, printing money indiscriminately can spark inflation, even hyperinflation, as famously happened in places like Zimbabwe. But the point is, a country that controls its own currency has the power to service its debt differently than a family or business does. Another difference is scale and buyers. When you borrow as an individual, the lenders are banks or friends. When a government borrows, lenders include individuals, pension funds, banks, and even its own central bank. We'll detail who in the next section. What matters here is that national debt represents ownership claims against future government revenue. It's an asset for someone, the holder of the bond, and a liability for the nation's government. To understand scale, consider major countries. The USA's $36 trillion debt equals about 122% of its annual economic output. Japan's debt is even bigger relative to the economy, about 250%. In other words, if the USA stopped earning anything and only used its entire output to repay debt, it would take more than a year, whereas Japan would need roughly 2.5 years of output. By contrast, many developing nations keep debt below 60% of GDP. Economists often use the debt-to-GDP ratio because it shows a country's ability to carry its debt load. 50% of GDP is one kind of context, 200% is another. Let's use a simple analogy. Imagine a nation as a household. If a family earns $100,000 a year and has $122,000 in mortgage, that's like 122% debt to income. The family could manage as long as interest payments are small and income is steady. If the family owed $250,000, 250%, even if it's wealthy, lenders would be more nervous. Similarly, Japan's gigantic debt hasn't yet blown up in its face, partly because lenders feel confident, interest rates are low, and most debt is held domestically. But high ratios do make some economists uneasy. For example, the EU's Stability Pact set a guideline around 60% of GDP as a sort of safe zone, not a strict limit, but a reference. Many countries now exceed that. In this section, we've defined national debt and highlighted how big it can be. The next question is, why do governments borrow so much instead of balancing the budget every year? That might seem obvious, to cover shortfalls, but the full answer has nuances. In the next section, we'll explore the main reasons governments issue debt. Everything from funding investments and emergencies to managing the economy and avoiding hyperinflation. If you wonder why even wealthy nations run deficits, it's because borrowing is often the least painful alternative to other options. Here are the main reasons governments borrow money, along with examples and analogies. Covering budget shortfalls, deficits. Just like a family might dip into savings or take a loan when monthly expenses exceed income, countries borrow when their spending outstrips tax revenue. For instance, in 2020, the US government spent so much on pandemic relief and saw its tax revenue fall that it ran a $3.1 trillion deficit, over 15% of GDP, rather than instantly raising taxes or cutting programs, which can crash an economy. Governments often issue debt to smooth over these shortfalls. This is akin to using a line of credit when cash flow is tight. Investing in growth. Borrowing to build things that pay off over time, like roads, schools, or technology, can boost future growth. Think of it as taking a mortgage on a business expansion. For example, if a country invests borrowed money in broadband internet or renewable energy infrastructure, the long-term economic returns, through higher productivity and jobs, can exceed the cost of debt. In development economics, investments in infrastructure and education financed by debt have sometimes accelerated economic takeoff. This is one reason even high-income nations maintain debt. They view it as fuel for long-term prosperity. Emergency response. Big shocks, wars, natural disasters, pandemics often force governments to spend massively when private activity slows. Without debt markets, governments would have no quick way to mobilize huge funds. In World War II, for instance, many countries borrowed and printed money to finance the war effort. Today's crises work similarly. Zimbabwe and Venezuela in the 21st century provide cautionary tales. In those cases, authorities tried to pay for spending by printing currency, which led to hyperinflation and economic collapse. By contrast, borrowing in domestic currency, through bonds, can inject cash without instantly devaluing the currency, though it raises the future debt bill. Refinancing. Old debt. Debt can be managed by rolling it over. A country might issue new bonds to pay off old ones when they mature. This is routine because most sovereign bonds have finite terms, like 10, 20, or 30 years. For example, if a government issued a 10-year bond in 2010, it would redeem that bond in 2020 by borrowing again. As long as investors are willing to buy new bonds at similar rates, the country can postpone principal repayment indefinitely. Monetary policy and inflation control. Sometimes governments issue debt not for budget reasons but to help central banks control the economy. In such cases, the central bank might sell government bonds to banks to soak up excess money from inflationary periods, or buy bonds during recessions to inject money. This interplay ensures that simply printing money, which can trigger high inflation, isn't the only tool. Each of these reasons illustrates a trade-off. The alternative to borrowing is either raising taxes or cutting spending, both of which have political and economic costs. Borrowing, on the other hand, spreads the cost out over time. Analogously, taking out a mortgage doesn't mean you can't pay your bills today. It means you pay interest and principal over decades. Countries borrow for the same reason people do, to do more now and pay later. But this comes at a price: interest. Lenders demand compensation, so debt must be serviced. In extreme cases, too much borrowing can become unsustainable. We'll soon examine those scenarios. For now, notice that the rise in global debt has been partly by design. Governments felt compelled to borrow during COVID-19 and other shocks. The IMF warns that if interest costs rise, as they have in many places recently, then servicing that debt could consume a significant share of budgets. In the OECD countries, interest spending is already about 3.3% of GDP, more than what many spend on defense. That statistic highlights the tipping point. Borrowing helps when affordable, but it can crowd out other spending if it grows too expensive. In summary, countries borrow to balance their books without crippling the economy, to invest in long-term projects, and to respond to crises. They weigh these benefits against the risk of higher interest costs and potential debt overhang. Next, we'll look at who provides these loans to governments, from individual investors to international institutions. When you think of lending to a government, picture a diverse crowd raising their hands to buy bonds. Government debt is owned by a wide range of lenders, both domestic and foreign. Domestic investors often hold the largest slice of a country's debt. In the US, for example, about 75% of the $36.2 trillion debt is held by domestic parties. That includes US individuals, banks, insurance companies, pension funds, and mutual funds, which in aggregate hold roughly 42% of debt. Another 20% is intragovernmental, meaning trust funds like Social Security holding treasury bonds. The Federal Reserve itself holds about 13%. Together, domestic sources keep the majority of US debt, and a similar pattern holds in many nations. This matters because when debt is bought by citizens or institutions at home, interest payments stay within the country's economy. Pension funds and insurers are especially important holders of government bonds. They need ultra-safe, long-duration assets to match their liabilities, future pension payments. Governments are effectively the only borrowers who can promise to pay back in their own currency. As a result, your retirement fund may very well own a piece of national debt. In some countries, pension and life insurers account for nearly a third of all government bonds outstanding, ensuring a steady, domestic base of demand. The other quarter of debt is usually financed by foreign lenders. These include other governments, foreign central banks, global banks, and overseas investors. In 2024, about 25% of U.S. debt was held by foreigners, about $9 trillion. The biggest foreign holders have traditionally been Japan, China, the UK, and smaller financial centers. Japan holds over $1.1 trillion of U.S. treasuries to back its own foreign reserves, and China holds around $765 billion. Many countries buy U.S. debt because it's seen as a stable asset for parking reserves and managing exchange rates. But foreign-held debt means interest payments go overseas. Indeed, when foreigners own bonds, the government sends part of its tax-collected interest abroad. This is a double-edged sword. Foreign investment can lower borrowing costs, but it shifts income outside the country. There's also the international bailout market. The IMF and World Bank lend directly to governments, especially in crises. However, these loans come with strings attached. For instance, IMF programs almost always require borrowing countries to implement austerity measures, cutting spending or raising taxes to ensure loans are repaid. That can provoke political backlash. Remember, when Greece hit a debt crisis in 2010, IMF and EU loans demanded harsh budget cuts, leading to years of protests. So while multilateral institutions provide vital funding, their conditions often tighten budgets. A few countries, especially those that issue a global reserve currency, have another source, their own central banks. In special cases, a central bank will monetize debt by buying large quantities of government bonds with newly created money. This happened worldwide during the 2008 crisis and 2020 pandemic, quantitative easing. It effectively finances government deficits via the printing press, but at the risk of inflation. Most countries limit this practice to controlled monetary policy and crisis response. In short, lenders to nations include domestic savers and institutions, foreign governments and investors, international organizations, and sometimes the country's own central bank. This diverse creditor base helps explain why debt can serve as a safe asset in the economy. It's widely in demand. It also means debt policy is watched by both local citizens and global markets. If one side gets spooked, say foreigners pull back their holdings, a country can face trouble rolling over its bonds. That scenario is part of what we'll cover next, when we discuss the pros and cons of high debt and what happens when markets lose confidence. For lenders, government debt often looks like the ultimate safe investment. Why? Because major governments have strong incentives and powers to repay. For countries that borrow in their own currency, default would mean refusing to pay with the currency they can print. In practice, governments rarely outright default on debt in their own money. That's why government bonds are considered among the safest assets in global finance. Think of government bonds as the financial equivalent of a guaranteed savings account. Banks, fund managers, and even ordinary citizens buy bonds knowing they'll get paid back plus a bit of interest. A U.S. Treasury bond or German Bund is seen as almost zero risk because history shows these governments have very low default rates. Many portfolios are built around the idea that even if stocks and corporate bonds tumble, government debt will still pay its coupon, even if low. This safety also makes government debt a backbone of the global financial system. Central banks around the world hold foreign government bonds, like U.S. Treasuries, as part of their reserves. They do this to stabilize exchange rates and have a safe outlet for their foreign currency. Individual savers benefit too. If you own a small government bond fund or buy your country's bonds through retirement accounts, you're lending to your government in exchange for regular interest. In that way, you and millions of others become the lenders of last resort to your own country. The demand from pensions and insurers is enormous. For example, in some advanced economies, roughly 30% of all national debt is held by pension and life insurance funds. These institutions buy bonds because they need long-term returns to meet future obligations. When government yields fall, Pensions often pour even more money into bonds, creating a stable market for government debt. Yet the interest rates on these bonds are typically very low, sometimes near zero or negative in real terms. This reflects trust in the borrower and also the lack of other low-risk places to park cash. During a financial crisis, investors flock to government bonds, seen as safe haven, which can drive prices up and yields down. This dynamic makes debt a self-reinforcing safety net in global finance. There's a flip side to all this safety. Because governments don't want to default, countries borrowing in their own currency effectively impose a limit on how much foreign debt they can sustainably hold. If a country borrows too much in foreign currency, like dollars or euros, it loses the privilege of just printing more local money to pay it. This is why emerging markets sometimes get into trouble when their foreign debt piles up and their currency weakens. They can't just crank up the local money press. For now, keep in mind that national debt forms the bedrock of global savings. It's why you can put your money somewhere ultra-safe, and it's why firms can buy government bonds with confidence. It also means that as governments borrow, they create the very bank reserves and financial securities that underpin our modern economy. In the next sections, we'll explore how this debt-safety trade-off plays out when borrowing goes out of control. Debt can be a powerful tool or a destructive force, depending on how it's handled. On the positive side, well-managed debt allows governments to invest in growth, stabilize economies, and share costs over time. For example, borrowing to build a new highway or a green energy grid is like taking out a long-term loan to boost the economy for decades. Those projects create jobs now, generate tax revenue later, and raise overall prosperity. Similarly, during recessions or emergencies, borrowing temporarily can prevent a complete economic collapse, much as a household might use a credit card to avoid bankruptcy after a medical emergency. In fact, many economists argue that taking on some debt speeds up growth. If the world's richest countries had tried to pay for all infrastructure and social programs with current taxes, a pay-as-you-go approach, growth would have been much slower. Instead, debt has helped finance technology, education, and infrastructure. Low interest rates in recent decades meant governments could borrow cheaply, in many cases at rates below their expected growth, effectively creating net gains for the economy. From this viewpoint, debt is not a burden but a capitalized future, a way to invest in tomorrow today. However, debt is a double-edged sword. Too much borrowing, or borrowing poorly, can hurt. The first danger is interest burden. Every year, government must pay interest on its debt. When debt levels rise, interest payments can become a large part of the budget. For instance, some emerging markets pay 40% of their revenue just in interest. In 2015, Brazil spent over 42% of its total government revenue on interest payments. That's money not going to schools, hospitals, or any public service. When interest costs grow faster than the economy, debt compounds. It's like if your credit card bill grows faster than your paycheck. Eventually, you can't keep up with minimum payments. The second danger is loss of flexibility. High-debt governments find it harder to respond to new crises. If a country is already running a large deficit, it may not be able to afford another round of fiscal stimulus without risking default. Credit rating agencies watch this closely. For example, Moody's lowered the U.S. credit rating in 2023, citing the fast-growing debt. A lower rating forces higher borrowing costs. Third is the risk of capital flight or currency pressures. Investors might shy away if they doubt repayment. We saw this with the Greek crisis, 2010-15, and Sri Lanka, 2022. Sri Lanka defaulted on its foreign debt in May 2022 after reserves dried up, leading to shortages of fuel and medicine and sharp inflation. Once confidence cracks, a debt spiral can happen. Currency collapses, inflation roars, and suddenly the debt is no longer manageable. Finally, there's political and generational fairness. Excessive borrowing can shift burdens to future taxpayers. If today's government borrows to fund current spending, tomorrow's taxpayers must repay. This raises questions. Is it fair that children pay for today's budget? On the other hand, if debt financed a useful investment, those future taxpayers might benefit too. To illustrate the double-edged nature, consider Japan again. Despite debt of approximately 250% of GDP, Japan has never defaulted. Why? Because almost all that debt is held at home and interest rates stayed near zero. Debt didn't disrupt Japan's economy. But contrast this with a country like Argentina in 2001. Its debt was much lower, around 50% of GDP, yet a mix of fixed exchange rates, fiscal missteps, and loss of investor confidence led to a catastrophic default. It shows that context matters. Debt can be sustainable if managed wisely. Low rates, strong growth, domestic lenders, or ruinous if risk factors, currency mismatches, high interest, align badly. Importantly, it's not just about numbers. Sound economic policy, like maintaining healthy tax revenues, prudent spending, and strong institutions, can allow higher debt without crisis. Conversely, mismanagement or corruption can topple governments even if debt looks moderate. In summary, debt is neither inherently good nor bad. Used as a tool for investment or crisis buffer, it can accelerate growth and stability. Used recklessly, it can blow up an economy. The key is balance. As the IMF notes, in bad scenarios, global debt could climb to 115% of GDP without corrective action. That highlights the precarious tightrope nations walk. Too little borrowing can stifle development. Too much can threaten solvency. In the next section, we'll see how economists and policymakers actually measure debt sustainability. We'll explore the common debt-to-GDP rule of thumb and why it's only a rough guide. Understanding those measures will help show why some debts are worrisome and others manageable. How much debt is too much? Economists often answer this by comparing debt to a country's GDP. The debt-to-GDP ratio is like the debt-to-income ratio for families. A 50% ratio means debt equals half of a year's economic output, whereas 150% means debt exceeds a year's output. This ratio provides a crude gauge of sustainability. It shows how big the debt burden is relative to the size of the economy that must ultimately service it. In practice, many advanced economies have debt to GDP well above traditional benchmarks. Back in 1992, the Maastricht Treaty set a reference of 60% debt to GDP for EU members, mostly to prevent unchecked borrowing. Today, nearly all developed countries exceed that level. For example, Germany, the UK, and the US hover near 100%, Italy around 140%, and Greece around 170%. Japan's 250% is off the charts. In fact, the IMF warns that if policies don't change, worldwide public debt could hit 115% of GDP under a stress scenario. But no single safe ratio exists. Some low-debt countries, like Estonia or Singapore, enjoy high credit ratings, whereas others carry heavy debts with little immediate trouble. What matters more is growth and interest rates. A country can keep a high debt ratio stable if its GDP grows faster than its debt service costs, or if interest rates remain extremely low. Japan is one example. Its debt has ballooned, yet very low interest rates and periodic inflation have kept interest payments manageable. Economists have tried to quantify danger levels. A famous, though debated study by Reinhardt and Rogoff suggested that when gross external debt, not the same as public debt, goes over about 60% of GDP, growth tends to slow. In the EU, 60% was the historic benchmark, though many view it now as an arbitrary target. The truth is, experts disagree on a universal safe level. A Pew Research survey noted that some think 70 to 80% is fine, while others worry about anything over 50%. What's clear is that context matters. Italy's 150% debt is seen as riskier than the US's 120%, in part because Italy's economy grows slower and it has less control over monetary policy. Beyond debt to GDP, analysts also look at interest costs and rollover needs. How much of annual revenue goes to interest? Brazil, for example, spent 42% of its revenue on interest payments as of 2015. When interest outlays become too large, fiscal flexibility shrinks. Another metric is the primary balance, whether a country runs a surplus or deficit ignoring interest payments. If a government only borrows to pay interest, running a primary deficit, that's a red flag. Debt grows autonomously. Credit ratings by agencies incorporate these measures along with political factors. In 2023, Moody's downgraded U.S. debt, partly citing its high borrowing levels. Investors also watch the maturity profile. If a big share of bonds must be rolled over in the next few years, refinancing risk is higher. For instance, nearly half of OECD government debt was set to mature by 2027, meaning countries must refinance or repay large sums soon. One more nuance: net debt versus gross debt. Gross debt includes everything owed, whereas net debt subtracts government assets, like foreign reserves. Some countries, Norway, Singapore, have low net debt because they hold huge wealth funds. So a 100% gross ratio might understate sustainability if assets are large. In practical terms, many economists agree that below 60% of GDP is a relatively modest burden, as the old EU rule suggested. Between 60% and 100% is probably still doable if the economy is growing. Above 100%, caution rises. Debt becomes a political issue and interest costs are under scrutiny. But as we've seen, even very high ratios can persist if managed. In summary, debt to GDP gives a quick sense of scale, but it's not destiny. It must be interpreted alongside growth rates, interest costs, and investor confidence. A sound economy can carry more debt. Conversely, a struggling economy can be crushed by moderate debt. Next, we'll delve into what happens when borrowing goes awry, the story of debt crises and defaults. No discussion of debt is complete without addressing its darkest chapters: crises and defaults. History offers many cautionary tales of what happens when borrowing spins out of control. In these episodes, governments run out of cash to pay creditors and are forced to restructure or abandon debt obligations. The result can be economic turmoil. Consider the recent case of Sri Lanka, 2022. After decades of heavy borrowing and a collapse in tourism and exports, Sri Lanka's foreign exchange reserves dried up. In May 2022, the government declared it would default on about $51 billion of external debt. Imports of essentials like fuel and medicine halted. The currency plunged, inflation surged, and widespread protests toppled the president. Sri Lanka's crisis shows how external debt, owed in foreign currencies, can quickly become unpayable if revenues fall. Because the country couldn't simply print more rupees to cover a bond denominated in dollars, it faced a choice: default or endure searing austerity. It defaulted. Another example is Argentina. It defaulted in 2001 on roughly $100 billion of debt after years of borrowing in dollars while trying to maintain a fixed exchange rate. When growth stagnated and reserves fell, Argentina became unable to roll over its obligations. The default triggered a deep depression, with poverty rates skyrocketing. Argentina has defaulted multiple times, illustrating chronic vulnerability when debt is mismanaged. In Europe, the Greek debt crisis, 2010 to 2015, marked a breakthrough moment for the Eurozone. Greece had rapidly accumulated debt under previous governments. When the global financial crisis hit, markets lost confidence. Interest rates on Greek bonds spiked, forcing Athens into a bailout with the IMF and EU. In return, Greece had to undertake severe austerity, raising taxes, cutting pensions, and slashing public jobs. Growth collapsed, and Greek society endured a lost decade of hardship. Eventually, Greece restructured, effectively a partial default, on its debts. This episode illustrates the social and political pain that can accompany sovereign debt crises. Even developed countries aren't immune to sharp adjustments. In 2020, the International Monetary Fund noted that global fiscal conditions were becoming dangerous, and some experts point to the possibility of systemic risk if several big economies hit trouble at once. High debt to GDP levels can be especially risky for countries that borrow heavily in foreign currencies or have volatile markets. On the other hand, as mentioned, a large domestic investor base can buffer a country. Japan's debt is mostly held by its own central bank and citizens, which helped it avoid default even with an enormous 250% ratio. Another dimension of crises is inflation and currency collapse. We already touched on hyperinflation in places like Venezuela and Zimbabwe. In those cases, governments essentially tried to solve debt problems by printing currency, which eroded confidence and collapsed the economy. This route is different from outright default. It is a hidden default where the debt is repaid in devalued currency. Eventually, even domestic creditors lose trust and capital flees. It's instructive to note that defaults are often preventable with policy choices. A common theme is that countries try to avoid tough reforms. Instead, they borrow more and kick the can down the road until suddenly the markets refuse to lend. That's why debt sustainability depends on policies as much as on arithmetic. As we consider these crises, remember that not all debt ends in disaster. The world still has many examples of high-debt countries functioning normally. Yet each crisis teaches one lesson: confidence is key. If lenders believe a government will make good on its loans, through fiscal reform or using reserves, borrowing can continue. But if confidence evaporates, even modest debt can trigger turmoil. Having seen the low points of debt, in the next section we'll step back and look at how debt interacts with the broader economy, with money supply, inflation, and everyday finance. We'll also touch on modern monetary concepts about how government debt is woven into the very fabric of a nation's money and wealth. So far, we've talked about debt as if it's just a number on a ledger. But debt is also the mirror image of something else: money. Every dollar of government debt corresponds to a dollar held by someone as an asset. In effect, when a government issues bonds, it is creating money-like instruments that circulate in the economy. To see this, picture your own savings account. The bank might use that money to buy government bonds, an asset, while your deposit is a liability for the bank. In aggregate, private sector savings often include large holdings of government debt. In that sense, national debt funds the money supply. Economist Richard Murphy points out that more than 80% of global debt is privately owned. Every citizen indirectly owns a piece of their government's debt through pensions, bonds, and bank deposits. Central banks also blur the line between money and debt. When a central bank buys government bonds, it pays by creating bank reserves, new money. For example, the U.S. Federal Reserve doubled its holdings of Treasury securities in the 2008 to 2020 period as part of quantitative easing. Those purchases injected cash into the financial system. In accounting terms, the government's liability, bonds, shifts from the market to the Fed, while the Fed's liability, reserves, goes up. The result is more broad money in the economy. This shows how monetary and fiscal policy intertwine. Government debt issuance and central bank actions jointly determine the money supply. Another angle is the international currency system. Many countries issue debt in foreign currencies, often US dollars, because it may attract more buyers. However, this creates vulnerabilities. If your currency depreciates, it costs much more in local terms to repay dollar debt. For example, Argentina's crises were fueled by pesos debt to dollar debt mismatches. By contrast, if a country issues debt in its own currency, like Japan or the UK, it technically can always print to pay bondholders. It can cause inflation if overdone, but it has that sovereign option. This is why a sovereign government technically cannot be forced into default on debt it issues in its own fiat currency. It can always create more currency to pay obligations. That's a profound difference from household debt, which has no such safety net. Modern monetary theory. MMT debates this principle at length. MMT proponents argue that a currency-issuing government doesn't need to borrow at all. It could simply credit accounts. In practice, governments issue debt and let markets set interest rates to help control inflation. As debt critic Richard Murphy notes, government debt is essentially a component of the money we all use. The choices governments make on debt issuance influence exchange rates and inflation. For instance, when a country prints money to pay debt, its currency tends to weaken. A weaker currency can stimulate exports, good, but make imports dearer and fuel inflation, bad. Balancing these forces is at the heart of national finance. What about the private sector? Government debt provides a foundation for savings and investment. Pension funds, insurance companies, and banks often hold government bonds because they offer a benchmark interest rate and liquidity. When governments borrow to invest in infrastructure or education, it can boost private sector productivity and incomes, which in turn helps repay that debt. On the flip side, if too much government borrowing crowds out the private sector by raising interest rates or absorbing savings, it could slow business investment. In normal times, however, a moderate amount of debt tends to complement the private economy by absorbing excess savings and providing secure assets. Finally, consider the global role of the dollar. The US can borrow in dollars while the rest of the world often holds dollar-denominated debt. This means foreigners effectively finance American deficits. While a quarter of US debt is foreign-owned, the rest is domestic. Countries like Japan and China hold these dollars in their foreign reserves, partly as government bonds. This reserve asset system means US debt is also a major source of currency stability worldwide. In sum, national debt is tightly linked to monetary economics. It creates money, anchors savings, and ties into inflation and currency regimes. This web of connections means debt policy isn't just about spreadsheets. It influences jobs, prices, and exchange rates. In our final section, we'll wrap up by looking ahead. How can governments manage debt responsibly, and what should citizens keep in mind? We've covered a lot. Every country borrows, but the reasons and consequences differ widely. Debt is a tool, and like any tool, its impact depends on how it's used. Savvy nations use borrowing to invest in growth or to weather shocks, while maintaining policies to keep interest manageable. For example, a government might aim for a debt-to-GDP path that stabilizes over time, paying extra toward principal in boom years. Others might deliberately grow debt during recessions and pay it down in expansions. What can we take away? First, remember that some debt is inevitable. Even strong economies like the US and Germany cannot credibly promise to run surpluses every year. They rely on borrowing to sustain social programs and infrastructure. In fact, attempts to balance budgets too quickly in a downturn can worsen recessions. Prudent borrowing allows governments to smooth taxes and spending over business cycles. Second, transparency and trust are key. Lenders, whether citizens, institutions, or other countries, must believe that debts will be honored. Countries that keep clear budgets and independent fiscal institutions, like debt boards, tend to borrow at lower costs. Contrast Japan, where debt has soared with little outcry, to places that lack fiscal discipline and suddenly face funding crunches. We saw how crucial credibility was during European sovereign debt crises. Greece had to accept harsh reforms to regain access to bond markets. Third, high debt requires plans. Sustaining debt doesn't mean ignoring it. Most economists argue that when debt exceeds certain thresholds, say 60 to 90% of GDP, governments should sketch credible medium-term fiscal adjustments to reassure markets. These adjustments could include gradual tax reforms, spending efficiency measures, or growth-enhancing policies so that GDP catches up to debt. The IMF and others say delaying these fixes is costly, meaning the sooner a country acts, the less drastic corrections are needed later. Finally, view debt in context. If debt finances growth, it can be justified. If it's used for waste or corruption, it's not. For example, borrowing to build schools or advance technology has different value than borrowing to pad short-term payouts. Citizens and voters ultimately decide these priorities. In democratic countries, the conversation about debt often becomes politicized. Should we raise taxes or cut spending? These debates matter, but they should be grounded in understanding what debt is and how it works, which is what we've aimed to provide. To sum up, debt itself is not inherently virtuous or evil. It's a financial promise. Responsible debt management means using that promise wisely and ensuring it can be kept without undue strain. Countries can even benefit if they invest in the future. But if debt grows out of control, they risk higher taxes, inflation, or crises down the road. As we've seen, even countries with debt to GDP far above 100%, like Japan, can function if markets trust them, whereas those with more modest debt, like some emerging markets, can falter if underlying policies fail. If you've watched this video, you now have a clearer picture of this complex topic. National debt touches everything from interest rates on your mortgage to the stability of global finance. By understanding its causes and consequences, you'll better follow debates on budgets, taxes, and economic policy in the years to come. If this explainer helped demystify how debt works, please like, comment, and subscribe for more in-depth videos. Let us know in the comments what topic you'd like us to tackle next. Your support not only keeps this channel thriving, but also helps these ideas reach more people who want to understand the world's economy. Thanks for watching, and stay curious.